So it is 1929 and the date is October the 29th. What is now referred to as Black Tuesday saw 16 million shares traded in just that day alone on the New York Stock Exchange. Billions of dollars were lost, wiping out thousands of investors. In the aftermath of Black Tuesday, America and the rest of the industrialized world spiraled downward into the Great Depression that lasted 10 years until 1939 and was the deepest and longest lasting economic downturn in the history of the Western industrialized world up to that time. So why did it happen? Well, in the 1920s or Roaring Twenties, we saw the stock market undergo a massive expansion with a long period of wild speculation in stocks that had no business being that high. With production decreasing, unemployment increasing, lower wages, higher debt, a struggling agricultural sector, and excessive levels of bank loans, the tipping point was reached and there was only one way that the stocks could head, and that was down and fast. It all started when stocks began to fall in September. No immediate reason to panic at that time as stocks do tend to fluctuate. But they continued to fall, and by October the 18th they really started to accelerate downwards, causing mass panic amongst traders looking to take their hard-earned money out of their investments. On October the 24th, a record 12.8 million shares were traded. Investment companies and leading bankers attempted to buy up most of the shares, leading to a temporary stabilization in the market, but it was not enough, and the market went into freefall. Black Monday followed with Black Tuesday on October the 29th, where the market collapsed completely, with over 16.4 million shares traded in a single day, where billions of dollars were lost, with thousands of investors losing everything. And so followed the Great Depression, with stock prices continuing to fall, and by 1932 most stocks were valued at just 20% of their value in the summer of 1929. By 1933, nearly half of America's banks had failed, and unemployment was approaching 15 million people, or 30% of the workforce. It took until 1939 for the economy to recover, when World War II reignited American industry. Following World War II, things went quite well for investors. Sure, there were plenty of peaks and troughs, but that is only normal and healthy, and it is true from looking at this historical timeline that the 1970s were as much a lost decade than that of the 2000s. Interesting that this chart also shows you the return you would have had in 2020 if you invested just $1 in 1870. It is of course fair to say that nobody has quite that long, but still remarkable, and just one reason why family wealth can grow over generations. The next big event was 1987 and what was termed Black Monday on October the 19th, where in just one day the Dow Jones fell 22% with the S&P 500 falling 20%. In the days leading up to October the 19th, the market started to fall with a 4% drop on the Dow on October the 14th and a further 2.5% the next day. And the next day on October the 16th saw the London Stock Exchange see declines of 5%. On Monday, October the 19th, the market started to fall in Hong Kong, and then as other countries began trading, the shock of Asia spread, causing panic in Europe, and by the time the US markets opened, they were all in freefall, causing the massive drops previously described. It has been said that the market was due for a correction following a strong bull run lasting for at least 5 years, as shown in the chart on screen, and it can be argued that this was a contributing factor. However, other fingers point to the advent of computerized trading, which took off in the mid-1980s. Unlike before, stop losses could be set and would automatically trigger a sale if a stock dropped below a set value. As you can imagine, this set off a domino effect, and the cause was simply a catastrophic fail. Another factor at play was the new concept of portfolio insurance, whereby large institutional investors would hedge their portfolios by taking short positions in S&P 500 futures. The portfolio investment strategies were designed to automatically increase their short futures positions if there was a significant decline in stock prices. On Black Monday, the practice triggered the same domino effect as the computerized trading programs. As stock prices declined, large investors sold short more S&P 500 futures contracts. The downward pressure in the futures market put additional selling pressure on the stock market. In short, the stock market dropped, which caused increased short selling in the futures market, which caused more investors to sell stocks, which caused more investors to short sell stock futures. So, as you can see, there were 3 likely causes of this sharp crash. One thing is for certain: stocks cannot go up indefinitely, and the other certainty is that history always repeats itself. However, unlike the 1929 crash and the subsequent deep depression which lasted for 10 years, the 1987 crash was relatively short-lived, with stocks returning to the 1987 levels by September of 1989, so just under 2 years later. Perhaps by now you are starting to see how not all stock market crashes are bad, and how, if someone could tell you when they are going to happen, it wouldn't be a bad time to get some cash ready. And so we move forward in time to 2008. However, with a brief stop to check in on the turn of the century. If you're old enough, can you remember them telling us to protect ourselves, or more so our computers, against the millennium bug? I remember being told that all electronic devices would stop working as the clock struck midnight in 2000, because our computers would be unable to handle such a change in their internal clocks and calendars. This may be my first living memory of media hysteria and fear-mongering, which unfortunately seems to have grown more in recent years than my stock returns. It was also the time when the internet was really taking off and people were seeing it as the future. Almost overnight, every night, new companies that were offering new and exciting technology were being created and promising us the world. But unfortunately, or not, depending how you see it, a huge percentage of these companies died out almost overnight in what was known as the dot-com bubble, when companies like Pets.com were wiped out just 9 months after their entry onto the stock market, and we were left with the likes of Amazon. Safe to say that it didn't turn out too bad for them. Moving forward to 2008 and more recent events, we are greeted with the subprime crash, which resulted in a global financial crisis, leading to the US and other governments around the world bailing out financial institutions due to them failing. Why did they fail? Well, a really good way to understand the problem is to watch The Big Short, a really brilliant movie showing the lead up to the crisis, and I feel that it explains really well how all of the issues leading up to the crash were too well known and really could have been fixed or avoided. In short, the crash was caused by a housing market bubble where too many high-risk loans were being offered to people that simply couldn't repay them. This resulted in people defaulting on their mortgage payments and the lenders not being able to absorb the hit. In other words, the financial institutions were simply being reckless. This is why nowadays you have to jump through far more hoops, such as proving you have the means to make the payments and having to undergo multiple checks to take out a mortgage, especially here in the UK. So if anyone from the US can tell me if big changes were made there, then please let me know in the comments. As a result of the housing market bubble bursting, stocks fell also massively. The image on show right now shows the impact the crash had on the S&P 500, although a full recovery was made in 5.5 years, with the march upwards continuing 320% to 2018 from the 2009 lows. It can also be noted how much you may have gained with an investment during those low points. I hope that you're enjoying this video and the information that I've offered. Please subscribe if you'd like more. So last but not least, we move on to 2020, and I'm not sure I really need to go into too much detail on why the stock market crashed last year. We all know full well what nasty biological invader made its appearance last year and turned our lives upside down. As a result of the subsequent lockdowns and business shutdowns, the stock markets around the world took a sharp and very fast tumble. At the time, nobody really knew what was happening, not only with friends and family and the natural concern for people's safety, but also what was going to happen to everyone's jobs. What if you worked in hospitality or retail and your businesses were forced to close? What would the knock-on effects be? It's now 2021 and over 18 months later, and the stock market's not only fully recovered but also went on a bull run, with stocks and indexes returning to previous levels in just a few months, as the on-screen chart shows. And what a great year for anyone holding Tesla stock, the darling of my portfolio. Will it work out as planned for the future? Maybe in 10 years' time I'll do a video charting the ups and downs of Tesla, and hopefully many more ups, so stick with me for that one. And of course, what does the future bring? Like I said, it is now 2021 and things are different. In certain parts of the world, supply chains have not yet fully recovered, prices seem to be on the rise quite significantly due to creeping inflation, and does this mean a return of higher interest rates? It doesn't seem right for a history channel to talk about the future, but history does have a nasty habit of repeating itself,